the master of reflexivity, lessons from the life and times of George Soros. Well, good morning. It's a pleasure to be with you all once again. We have spent our time discussing investors who focus on the intrinsic qualities of individual businesses, the value of their assets, the quality of their management, the durability of their growth. Today, we turn to a man who operates in a different dimension altogether. He is less concerned with the fundamental value of a single company and more concerned with the fundamental, often fatal, flaws in an entire system. He is a macro-strategist, a student of historical chaos, and a living testament to the power of marrying a profound philosophical hypothesis with the absolute merciless conviction of a speculative bet. He is not an investor in the traditional sense. He is a financial philosopher king who uses capital as a tool to test his theories about how the world truly works. His name is George Soros, and his story is not one of slow, steady compounding. It is a story of seismic shifts, of identifying those rare historic moments when a nation's economic policy is built on a foundational lie, and having the intellectual clarity and raw courage to bet everything on the truth reasserting itself. His life teaches us that markets are not just about economics and spreadsheets. They are about mass psychology, political fragility, and the profound, often dangerous ways in which our collective perceptions can create and then shatter reality itself. He is the architect of the concept that made him infamous. Reflexivity. Act 1. The forging of a survivor's instinct. From Budapest to the London School of Economics. To understand the unique and formidable mind of George Soros, you must first understand the crucible of his beginnings. He was born György Schwartz in Budapest, Hungary in 1930, into a prosperous, assimilated Jewish family. As a 14-year-old boy, he lived through the nightmare of the Nazi occupation of Hungary in 1944. This was not a distant historical event. It was a daily, immediate fight for survival. He survived by assuming a false Christian identity, using forged papers provided by his resourceful father, and helping his family evade deportation and almost certain death by dispersing and hiding. This harrowing experience was more than a trauma. It was a brutal, formative education in the nature of reality. It taught him that the established social and political order is terrifyingly fragile, that official narratives can be lethal fictions, and that the world is an inherently unstable, unpredictable place. Most importantly, it imprinted upon him the survivor's supreme skill, recognizing when a regime or a system has entered its endgame, when its foundations are rotten and its collapse is inevitable. This instinct would later become the cornerstone of his investment methodology. After the war, he emigrated to England, alone and penniless. He worked as a railway porter and a waiter before being admitted to the London School of Economics. There, he fell under the spell of the philosopher Karl Popper. Popper's masterwork, The Open Society and Its Enemies, and his concept of the open society. A society built on critical debate, fallibilism, democratic institutions, and respect for individual rights became a lifelong, guiding, intellectual, and moral compass for Soros. It also provided the philosophical bedrock for his most important contribution to finance, the theory of reflexivity. Popper argued that in science, a theory can never be fully proven, only falsified. Soros would adapt this to markets. A market thesis is never certain, but it can be tested, and the ultimate test is to bet on it. He moved to the United States in the 1950s and began his career in finance, first as a humble arbitrage clerk, and then as an analyst. In 1969, he founded what would become his legendary vehicle, the Quantum Fund, originally the Double Eagle Fund. From its inception, he was not a traditional stock picker. He was a global strategist, a hunter of profound imbalances in currencies, in commodities, in the very interest rate policies of nations. He was building the toolkit to test his emerging philosophical ideas in the most rigorous laboratory of all, the global marketplace. Act 2, the theory of reflexivity, the alchemy of finance and fallibility. Most classical and neoclassical economic theory is built on the elegant, comforting idea of equilibrium. It assumes that market participants are fundamentally rational actors, that they base their decisions on objective information, or at least the best available, and that this collective rationality leads prices to eventually, efficiently reflect the underlying economic fundamentals. George Soros came to believe this was not just incomplete, but a dangerous fantasy that blinded people to how markets actually behaved. He proposed a radical alternative, which he termed reflexivity. He argued that in social systems, and financial markets are the ultimate social system, there is a powerful two-way feedback loop between participants' perceptions and the underlying reality they are trying to perceive. This loop creates not equilibrium, but a state of perpetual dynamic disequilibrium. Here is the elegant, devastating mechanism, the cognitive function. This is our attempt to understand the world. We look at a company, a currency, or an economy, and we form a view, a bias. This bias is always imperfect, incomplete, and subjective. We do not see reality as it is. We see it through a lens of our own beliefs, experiences, and herd mentality. The manipulative, or participatory, function. This is where we act on our biased views. If we believe a stock is undervalued, we buy it. If we believe a currency is doomed, we sell it. But here's the crucial twist. Our actions, based on our biased perceptions, actually change the underlying reality itself. If enough people believe the stock is undervalued and buy it, their collective buying pressure makes the stock go up, which then validates and reinforces their initial biased belief. This validation leads to more buying, which pushes the price even higher, further distorting the initial fundamental reality. This creates a self-reinforcing reflexive loop. A boom can feed on itself, driven not by improving fundamentals, but by a collectively held bias that its own actions are making temporarily true. Soros called these virtuous loops fertile fallacies or bullish biases. But because the process is built on a cognitive error, a divergence from a stable underlying reality, it cannot sustain itself indefinitely. The gap between market price, shaped by perception, and any anchor of fundamental value becomes a chasm. Eventually, the weight of the contradiction becomes unbearable. A trigger occurs, confidence shatters, and the reflexive loop reverses violently. The same feedback mechanism then works in reverse, accelerating the collapse. The fertile fallacy becomes a vicious circle. Soros did not see markets as efficient machines. He saw them as historical processes, constantly evolving, prone to manic euphoria and depressive panic, moving in great, sweeping, reflexive cycles of boom and bust. His entire investment strategy was built on identifying these cycles in their early or late stages, understanding the prevailing bias, and having the courage to bet against it when he identified the fatal flaw. Act 3. The bet that broke the Bank of England. Reflexivity in the real world. This theory was not an abstract intellectual hobby. It was the high-octane fuel behind the single most famous speculative trade in modern financial history. In 1992, Soros and his quantum fund, led by his brilliant deputy Stanley Druckenmiller, identified a colossal, textbook reflexive situation in the European exchange rate mechanism, or ERM. The ERM was a system designed to reduce exchange rate volatility between European currencies before the introduction of the euro. It essentially pegged currencies, like the British pound, within a narrow band against the mighty German Deutschmark. Great Britain had joined this system, but Soros believed the peg was a grand political fiction, a fertile fallacy, doomed to fail. The fundamental reality was stark. Britain's economy was languishing in recession with high inflation, requiring low interest rates to stimulate growth. Germany, grappling with the costly reunification of East and West, needed high interest rates to control inflation. To maintain the pound's peg to the strong Deutschmark, the Bank of England was forced to keep British interest rates painfully high, strangling its own economy. This contradiction was unsustainable. Soros saw this as the perfect reflexive setup. The market's perception of the pound's strength, enforced by political will and central bank intervention, was profoundly false. He believed this false perception was a bubble waiting to burst, and he decided not just to predict its collapse, but to be the catalyst. He began to test his hypothesis on a gargantuan scale. The quantum fund borrowed billions of pounds, leveraging their capital many times over, and sold them on the open market, building a massive, concentrated short position against the currency. This was not passive analysis. It was an active assault on the prevailing bias. His selling created immense selling pressure on the pound. To defend the peg, the Bank of England was forced to burn through its foreign currency reserves, buying pounds at the artificially high rate. This desperate defense only served to highlight the system's fundamental weakness, attracting more and more speculative sharks to the scent of blood. Soros's actions were initiating the reflexive feedback loop against the pound. The climax arrived on September 16, 1992, forever known as Black Wednesday. After spending tens of billions in a futile defense, the British government capitulated. It withdrew the pound from the ERM and let it float freely. The currency plummeted. In a single legendary day, Soros's quantum fund netted a profit exceeding $1 billion. He was famously dubbed the man who broke the Bank of England. This trade was the theory of reflexivity executed in its purest, most powerful, and most profitable form. He identified a flawed collective perception, acted upon it with overwhelming force in a way that actively changed the underlying reality by draining reserves and destroying confidence, and profited from the inevitable reflexive collapse of the contradiction. It was philosophy turned into warfare, and speculation turned into a self-fulfilling prophecy. Act 4, the quantum approach, a method for navigating disequilibrium. Soros's investment process, honed over decades, was a direct application of his philosophical framework. It was less about crunching numbers and more about interpreting history in real time. 1. The search for the fertile fallacy. He and his team constantly scanned the world for situations where a widely held market belief was in fundamental, unsustainable conflict with the underlying economic or political facts. They looked for booms built on sand or institutions defending an indefensible policy. 2. Betting the thesis. When such a flaw was identified, the next step was not a small, tentative position. If the analysis suggested an asymmetric opportunity, or the potential gain vastly outweighed the calculable risk, Soros advocated going all in. He would bet the thesis, allocating a huge portion of the fund's capital to the trade. This required an iron stomach and an unshakable belief in one's own analysis. 3. The momentum trap and the exit. Riding a reflexive trend requires understanding that momentum can carry prices far beyond where any rational model says they should go. Soros was a master of staying with the trend, of being a pig, as Druckenmiller later put it. However, he was acutely aware that all reflexive booms end. The key was not to predict the exact top, but to recognize when the fundamental flaw had been resolved or exploded, when the bias was exhausted. The exit strategy was based on monitoring the changing reality, not just the price chart. 4. A cathedral of fallibility. Perhaps the most profound aspect of Soros's mindset was his ingrained sense of his own fallibility. He knew his own theories could be wrong, his analysis flawed. This wasn't a weakness, it was his greatest risk management tool. He was famously quick to admit painful mistakes and reverse losing positions, often at a significant loss. He lived by the principle that it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. Preservation of capital during incorrect theses was what allowed for explosive gains during correct ones. The timeless lessons for us. The legacy of George Soros offers a masterclass in thinking differently about markets, risk, and our own minds. These lessons are universal. 1. Markets are not efficient. They are historical and inherently flawed. Liberate yourself from the dogma of the rational, efficient market. Prices are not passive reflections. They are active, psychological forces that can bend and break the fundamentals they are supposed to represent for long periods. The biggest opportunities and dangers lie in understanding these flaws, not in ignoring them. 2. Hunt for the fault line between story and reality. Soros was a master forensic analyst of narratives. Look for situations in a company, a sector, or a country where the official, optimistic story is starkly contradicted by the hard data on the balance sheet, in the economic reports, or in the political calculus. These fault lines are where reflexive quakes begin. 3. Conviction is the multiplier of insight. It is not enough to have a clever idea. Soros's real genius was in the marriage of deep insight with extreme conviction in position sizing. When you identify a truly asymmetric, high-probability opportunity where you have a clear edge in understanding a reflexive dynamic, have the courage to back it with meaningful size. Bet your hypothesis, don't just dip a toe. 4. Your greatest enemy is your own infallibility bias. The most critical lesson of reflexivity is that it applies to you. Your own cognitive biases, your ego, your desire to be right can distort your judgment and trap you in your own erroneous reflexive loop. Cultivate what Soros called radical fallibility. Be your own fiercest critic. Admit mistakes quickly and without ego. The market is a brutal mechanism for falsifying theories. Listen to it. 5. Follow the reflexive trend, but know it is a temporary god. Soros was the ultimate trend follower, but of a specific kind, the reflexive trend driven by a prevailing bias. He understood these trends have a life cycle: birth, growth, maturation, and death. The skill is not just in identifying the birth, but in sensing the maturation, when the disconnect from reality becomes terminal. Have a hypothesis for what will break the trend, and be prepared to walk away when it does. In the end, George Soros' legacy is a profound and unsettling understanding of the deeply human, often irrational, and always reflexive nature of the financial world. He showed us that the most monumental profits are made not by analyzing a company's cash flow in isolation, but by diagnosing the collective psychosis of nations and the structural cracks in global systems. He proved that to be a transcendent figure in finance, you must sometimes be more than a financier. You must be a philosopher with a theory of history, a psychologist of crowds, a student of political power, and, when the moment demands it, a speculator with the nerve to place a billion-dollar bet that you are not just predicting history, but helping to shape it. He remains the master of reflexivity, a thinker who saw the feedback loops that govern our world and dared to step into the current. Thank you.